The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Trump, tariffs, and social media. For Wall Street, it's deja vu all over again. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and it is 2016. We erased 8 years. That's how it feels like a little bit when we're taking into account some of these headlines. What's different than 2016? Fed cuts, but also what we're seeing within the market. The S&P is up by 0.4%. We are currently sitting at a record high on the S&P. That will be 52 record highs so far this year. But from what Romaine was talking about in terms of the Trump effect, right? You're seeing higher yields and a stronger dollar, and that permeating throughout the day, Romaine.
All right, well, for the record, it is definitely 2024, but to Alex's point, a taste of the volatility that was a hallmark of the first Trump administration back in 2016, rearing its head just hours ago. The president-elect pumping out a post on Truth Social, vowing to impose 25% tariffs on Mexico and Canada, the peso and loonie weakening, gold and silver waning, and the stock market wobbling just a bit. Automakers among the hardest hit today, with Ford slipping as much as 3% and General Motors, get this, having its worst day since 2022.
The market's kind of been on top of this. If you look where volatility markets have been pricing risk premiums, it's been in precious metals, it's been in China exposed equities, and it's been in the currencies.
And retail stocks not doing much better. The threat of increased tariffs up ahead, combined with disappointing earnings in the here and now. And you're seeing quite a few discretionary names sell off here on the day. That includes Best Buy sliding the most since 2022, Kohl's hitting its lowest level since 2020, and Leslie's, a maker of pool equipment, headed for a record one-day drop to a record low closing price. Look for more commentary on the tariff issue tonight from executives at Urban Outfitters, Nordstrom, and Guess. Each report earnings after the bell. And of course, all this belies the tinge of optimism that is still coursing through the markets. The S&P rallying for a seventh day to yet another potential record high as more economic data shows more support for the notion of a healthy economy. An easing in price pressures and a still favorable job market, lifting the Conference Board's gauge of consumer confidence to the highest level, Alex, in more than a year. Are you confident?
I'm TBD. I'm TBD on that. In terms of the future expectations, also we're around a 3-month high on that. So this is an interesting way of looking at tariffs. Thank you so much, Terrell Holt, for looking at that. It's AI identified mentions of tariffs in S&P 500 transcripts. Now you can see the jump that we've seen in that just in November. We're now at 80 calls on transcripts about tariffs, because it raises the question, what impact will tariffs have on companies and their earnings? Deutsche Bank says that if you take a look at those potential tariffs on Mexico and Canadian imports, that could lift core PCE inflation above 3% next year. And that has ramifications on companies, on buying and consumer confidence, and also on the Fed, Romaine.
All right, let's kick things off. Greg Peters joining us right now, co-CIO at PGIM Fixed Income. And Greg, I'm going to piggyback off what Alex was just talking about here. Can we take investors, can they take that playbook from that 2016 to 2020 era and apply it to whatever that 2025 to 2029 era is going to look like?
I don't think you can completely, as the preconditions are very different today, right? If you're looking at just where we are economically, we're in a very strong place. Inflation, is definitely much higher. Markets on a very different plane. So I think it's somewhat inaccurate to use what happened in 2016 to today. But alas, that's what you're seeing. So what you're seeing currently is that investors are kind of dismissing any of the negativity around tariffs, any of the negativity around immigration, for example, and really kind of uplifting and bolstering some of the more favorable potential policies like tax cuts and deregulation.
There has been a narrative since the election of this idea that the administration coming in is going to be relatively pro-business, at least relative to what we saw out of the Biden administration. And that could sort of create favorable conditions, whether it's for M&A activity or new business creation, et cetera. I'm wondering, Greg, if you see conflict between some of those pro-business policies that I think the market is counting on and things like tariffs and other proposals that have the potential to detract from the economy and the markets.
No, absolutely. And I go back to where I started, which is investors are only amplifying the good, and they're, not really focused on the potential negatives. So, I do think the volatility, the uncertainty, the more idiosyncratic nature of this administration, coming in doesn't always engender confidence, right? If you go back to, the first term, there was a lot of bolts from the blue that hit, whether at the individual corporate level or just from an overall policy level. So that makes it harder to, do M&A, makes it harder, I think, to push the markets to a much higher plane. What I think it does say ultimately is that volatility will remain quite elevated here.
Which then begs the question what it winds up meaning for the Fed. I mean, already in the minutes today, it seemed like they could cut more or they could pause depending on what the data called for. And we're already looking at little over 20 basis points worth of cuts just in the next couple meetings. Like, we've re-rated so much, and you have to wonder if the headline and volatility risk changes that dynamic even more.
Yeah, so I think the markets were way offside as far as where the Fed was predicted to go. I think we're in a much more stable, thoughtful place today. But the way we think about it at PGIM Fixed Income is that we want to get to neutral. And so I know neutral is very much of a debated concept, but think of it as a range from 4% to 2.5%. And if you think about where central bank policy rates have been set, they were set in a much, much higher inflationary type of regime. So we're not in that regime anymore. So I think we get to 4%. And then we revisit, and that's lower than where we are today. And I think that's the real message here.
When we talk about volatility, Greg, and I know you're a fixed income guy, but where do we see the most volatility, in what asset class, and then how do you manage that?
Well, where the volatility has been in fixed income. So I expect that to continue. I mean, the moves that we've seen in the front end, the 2-year, for example, even the 10-year, has been nothing short of extraordinary. What's really notable here is typically what you see is when the Fed, in this case, starts cutting rates, volatility comes down. We haven't seen it this time. So I don't know if it's the canary in the coal mine or not, but it is quite notable that you haven't seen volatility really trend lower in a meaningful way in spite of the Fed embarking on a rate cutting cycle.
How tight are the correlations right now, though, Greg? When we look at the moves, or to a certain extent, the lack of moves in the Treasury market, and then you overlay that with what we've seen in equities and even what we've seen in the FX and the commodity space here, are you still seeing strong correlations or traditional correlations, I should say?
No, you've seen it switch around. That's one of the positive aspects here around active investing. You've seen those correlations break down. You've seen them move. You've seen it particularly from a global bond market perspective. If you think about kind of what's happened in the Bund space versus treasuries, so we're most excited around those correlations actually lightening and switching. Kind of the worst type of investment environment is when there's a correlation of one across. And thankfully, we're not in that type of environment going forward. So I expect that to continue. I expect those correlations to break and lighten and switch. And I think that's the real investment opportunity for 2025.
As people look to 2025, and particularly the opportunities, they are focused on the risk. We've touched on a couple of them already with regards to tariffs, immigration, et cetera. I do want to get your thoughts specifically on the fiscal situation, based on, I guess, some of the speculation of what we know about the potential incoming Treasury Secretary, as well as some of the other policies that the Trump economic team, at least the ones that he has assembled for nomination, have been espousing. Do you anticipate that could have a major impact on rates?
I do. One of the real concerns, that I have and we have at the firm is the fiscal situation. You look at, the tax cuts being rolled forward and some other agenda items. You're not seeing any change on the fiscal side. There's talks around, cutting some fiscal expenses. That's a really, really small portion. So I think fiscal profligacy is here to stay. And ultimately, the bond market will react. I think the most telling statistic is if you look at kind of interest costs 10 years forward, it almost equates to 25% of the income coming in. So we're getting dangerously close to this, what we call debt trap, debt spiral, and the markets will focus on it. The worry is that you never know when the markets will really, truly in earnest start to focus on it. So that is the principal concern that I have going forward.
Well, Greg, it seems like what you're talking about is a Liz Truss moment where something is unveiled and the market decides this is not sustainable, and then bond yields spike higher, it causes chaos. But couldn't we have said this 10 years ago?
Well, that's the thing. You don't know till you know. But I do think what's happened in the UK, is a warning shot, so to speak. You had a whiff of it just a couple weeks ago, but in the UK as well. You've seen it in France. So the signs are there. So, the scary part is that you really don't know until after it occurs. There is a breaking point. There's no magical number. But at some point, the markets have to believe that the fiscal side is under control or there's a plan. And we haven't really seen a plan. And if you look at what happened in the UK as an example, it's been the lack of plan that's really kind of, hurt that the most.
So does that mean you have the conviction then to short the back end based on that, or what had his strategy?
Well, what I think it means is all else equal, there'll be pressure on yields, right? You look at the amount of treasury supply coming, you look at the shifting buyer base who's absorbing that supply, you look at the policies on the table, all else equal, that creates a steeper curve, that creates additional risk premium. So I think the pressure will be yields higher, not lower, just based on the fiscal situation alone.
Well, when you say that, though, Greg, I assume you're referring to benchmark yields. What's the disparity that we can see versus the longer end of the curve and the absolute shortest end around the 2-year and less?
Well, so the curve's been extremely flat and inverted for quite some time. So, I could see, that continue to move, higher. What that magical number is, I don't know, because that gets us back to the Fed side. So I think the Fed is equally worried around the growth hit to tariffs as it is inflation. So we'll see. But I think either way, the curve will be steeper going forward, not flatter. We're coming out of this extremely strange era of curve inversion, and we're moving back to some sort of normalcy.
Greg, we really appreciate it. Thank you so very much for joining us. Greg Peters, co-CIO over at PGIM Fixed Income.
I just laugh every time you bring up Liz Truss.
What?
Can we leave this woman alone?
I mean,
she did her best.
She has a moment named after her now.
She does.
I mean, come on. That's infamy at the end of the day. All right, stick with the macro here and turn to how markets will react under a new administration, from M&A to IPOs. Here with us now on set is Barnaby Lyons, global head of Bain Capital Special Solutions, with Invest and partners with companies to fund growth in M&A, and recently raised almost $6 billion. Barnaby, lovely to see you. Thank you for joining us.
Thank you both for having me.
Greg Peters was saying previously that the volatility in the markets potentially could hurt M&A, could hurt IPOs. That's your world. What do you think?
Absolutely. There's undoubtedly an elevated level of uncertainty today. Just take the Trump administration. There's a lot that could drive growth, whether it's deregulation, whether it's tax cuts, but there's also a lot that could constrain growth, tariffs, immigration controls, and of course geopolitics is a wild card. What we do at Bain Capital Special Sits is actually provide solutions irrespective of the macro environment. We provide structured solutions that offer an alternative between private credit and private equity, often bridging a bid-ask spread that exists in moments of uncertainty. And so for us, it's actually a really great time to be investing.
So does the macro make your world easier or harder to invest? And where are those opportunities right now?
Yeah, sure. We have a strategy that pursues both structural opportunities that persist through cycles and those that are more macro-driven. We pursue 3 different types of deals. The first is what we call capital solutions. These are bespoke financings to companies that for some reason private credit or private equity may be the wrong solution. We invest in real assets, but we're not forced to be a real asset investor. We pick our moments where there's capital shortfalls. And occasionally where markets are dislocated, we invest in distressed. Distressed, that's absolutely the most cyclical. We wait for moments, really has not been active since 2020. Capital solutions is structural. There's a lot of companies seeking partnership capital in a structural form, in a structured form. Hard assets obviously has an element of both. Some tailwinds we're pursuing in aviation and digital infrastructure that are more systemic, as well as stress in some of the commercial real estate sectors that have been impacted by the rate environment.
But on the capital structure side, and when you think about where interest rates are going, or at least where the market thinks interest rates are going, and also the idea that a lot of people thought we were headed for worse economic conditions, and the idea that that didn't necessarily materialize, at least not here in the U.S., does that make that business tougher, more competitive for you as you move into next year and beyond?
Again, we're accessing opportunities that are sometimes driven by structural themes and sometimes cyclical.
Yeah.
Absolutely, there's been a bid-ask spread in the capital markets over the last couple of years, where as we see markets start to normalize in the years ahead and the buoyancy that we're seeing in particular here in the US, some of those opportunities may get sold by the public markets, by the equity, by the high yield market, whereas previously they would have been a special sit solution. But there's also increasingly we see large-scale corporates as well as entrepreneur-owned businesses that see the value in what we do. Basically a private equity style operating partnership and strategic partnership alongside structured capital that doesn't have the same dilution as selling their business. And that's structural and that's here to stay.
That's here to stay. On the distress side, where is the opportunity going to be there, particularly if economic projections as they stand now continue, which is basically continued growth, modest growth, but growth?
Yeah, absolutely. So frankly, distressed has been less of a focus for us the last couple of years. Companies did raise a lot of capital during COVID.
Everyone's waiting for it.
A lot of that capital was pretty flexible capital, very limited covenants. Companies had decent cash balances, and the world has been more positive than we expected. As we look forward, we expect a little bit of a rise in default rates as we think about the maturity walls in 25 and 26, but frankly not material. This isn't an 08, 09 opportunity. We're more focused on the structural opportunities that we're accessing.
Do you feel like you're being compensated for the risk that you have to take?
Absolutely. The last 2 or 3 years in the environment we're seeing right now is one of the best environments I've seen in my career. We're able to attach at companies at material discounts to their fair value with big equity cushions behind and get a floor return because of the rate environment, because of the pullback we've seen in credit the last couple of years that's very high, but because we're bringing partnership, also get equity upsides. And it's that balance that's actually helped us been successful in our fundraise that you mentioned at the beginning.
I know you're kind of focused here on the U.S., but given your background in Europe, I am curious as to whether there is a potential for more cross-border deals in a way that we didn't necessarily see over the last 4 years, primarily because of kind of the regulatory threats, not only from the U.S., but even from the EU. Do you think that will shift, that will change, that will ease a little bit next year?
Our focus is actually global, not US focused. It's US, Europe, and Asia. We have a large business. I actually sit in Hong Kong. And a big part of our business is funding companies as they go cross-border. Often companies, when they go to a new market, they lose their banking relationships. They lose their access to the capital markets in a way they have at home. Also, they're looking for an operating partner, someone who understands the local jurisdiction. We've done a couple of deals as examples with Korean chaebol, some of the big conglomerates in Korea, making strategic investments here in North America.
In the U.S.?
In the U.S., but where they want an operating partner to come with them to help navigate the cultural differences, the operating environment here, the regulatory environment here. We've done this in food, we've done this in renewable energy, and they really value someone who can operate in a structured way without losing control, operating on a global basis. And so that's actually a pretty steady flow for us, and we see it increasing.
So with the potential tariff threat on China, Canada, and Mexico, what does that mean for that business you're just describing?
Sure, we're spending a lot of time really trying to understand the shifting sands
doing everybody else.
with everyone else, and there's a lot of uncertainty. One day it's 60%, the next day it's 10%. And we're spending a lot of time also trying to understand how the relativity of tariffs are going to play out, because it's not just raising tariffs on China and what that might do to China, it's how the relative position of China versus many other markets changes that affects trade flows. That said, there's going to be some clear winners in the long run, in our view. The redrawing of supply chains to markets like Southeast Asia, to India, have created pretty interesting opportunities for us as well, and we've been active in those markets.
Barnaby, great conversation. Really appreciate you stopping by. Barnaby Lyons is the global head of Bain Capital Special Situations. As we continue to count you down to the close here on this Tuesday afternoon, when we come back, a closer look at some of the big individual movers in U.S. equity markets, and that includes Pinterest. We're going to speak to an analyst about why he says now is the time to buy the shares. That's coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Zoom Communications, online meetings platform ditching the video from its name, and Evercore ISI ditching its inline rating and upgrade to outperform a street-high price target of 115. That's on the heels of the company's earnings report yesterday, which showed another very solid quarter full of positive execution and newer product offerings. The shares, though, down 6% on the day. Next up, Capri upgraded to buy at Guggenheim, the analyst citing avenues for value creation and an earnings recovery at the apparel company, with its Versace and Jimmy Choo brands continuing to be attractive. And while Capri's Michael Kors line has deteriorated, there's nothing a change in leadership couldn't fix. Those shares higher by 5% on the day. And let's end things with Pinterest. TD Cowen starting coverage of the social media site, a buy rating, a $38 price target. The analyst citing multiple levers of monetization, from the way it uses AI for advertising to its ability to stabilize user engagement. Pinterest shares getting a modest bid on the day, up almost 2% to 31.05. And those are some of our top calls. We're going to stick with Pinterest, and we're going to stick with that call. John Blackledge joining us right now, managing director and senior research analyst over at TD Cowen, picking up coverage. And you just going through this note, John, you seem to be pretty confident here that management, that executives are going to find a way to better monetize the existing user base. How do they do that?
Yeah, I mean, well, what's interesting and what we saw, and we leveraged our proprietary TD Cowen survey data of 2,500 U.S. consumers. One thing we saw was time spent is up in 4Q in the U.S. Overall, and up 15% with 18 to 34-year-olds, which is PIN's largest and fastest growing cohort. And at the same time, though, PIN's is increasing its ad load in kind of its highest purchase intent areas of the platform, which is driving, in part, driving that monetization. And just given that PIN's main use case is, per our survey data, is finding or products or to shop for, we think that engagement can grow while Pinterest increases their ad load. And this isn't necessarily intuitive, right? You know, when a platform increases the number of ads that people are seeing, it could usually have a negative impact on user engagement. But just given the nature of the PIN's platform and the core use case, our data shows rising engagement despite the higher ad load. And as a result, you know, ARPU has been accelerating over the last year and change, and we expect ARPU to accelerate over the next couple of years.
How much are they making then per user, John?
They in the U.S. and Canada, they're doing $26 per user. It's about 15% of Meta. So there's a really big gap. And one of the other differentiated things that we think we did in the report was just do an ARPU sensitivity analysis and say, hey, can they close the gap on this massive gap with Meta? And what we saw was if you grew just the U.S. and Canada ARPU, which is about 80% of the revenue, if you grew that $26 per user, if you grew that 1% higher than our current estimates over the forecast period, there would be a 2% bump in annual revenue growth and a 4% bump in annual EPS growth. Yeah. And if you were to apply that globally, you'd see an even greater bump. So you know, we think there's a lot of levers, as you guys started with, and as we wrote about, to drive monetization on the platform. And we think the stock is going to be a good one, you know, as we exit this year and into next year.
I am curious just about the future of this company. There's been a lot of talk about how it's kind of a niche player in the social media space, and maybe it's okay with that the same way that Snap is okay with that as well. But of course, it also raises a lot of speculation about potential M&A activity, whether an outside company would be interested in Pinterest. I am curious as to whether you see more of a growth story for this company, or is this just kind of them finding a niche and exploiting it for profit?
I think both. I mean, you know, we have 13% annual revenue growth next 5 years, 19% annual EBITDA growth the next 5 years. And the margins have expanded nicely over the last, 18 months, and we expect further margin expansion in the next 5 years. And that's driving significant free cash flow. We have over 20% free cash flow growth the next 5 years. And you've seen them be shareholder friendly with their free cash flow. They're doing buybacks, and so I don't think they're acquired. I don't think any of the big players, just given regulatory, can acquire them. Yeah. So I think I think they're going to kind of go on their own, and it's a good platform. And again, looping back, we think it'll be a good stock.
All right, John, thanks a lot. We really appreciate it. Thank you very much, John and Blackledge over at TD Cowen. Pinterest is up by almost 2% on the day. All right, coming up, the impacts of tariffs under President-elect Donald Trump. We're going to take a look at it from the economic side, the Fed side, as well as the auto side. General Motors, one of the worst performing stocks within the S&P. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. Looks like we're going to hit it. 52 record closes for the S&P. We're very much on track.
Yeah, we're holding it just by a little bit of a hair, Alex Steele. The Dow at a record high as well. Interesting reversal, though, from yesterday for the Russell 2000 and all those cyclicals that we were all touting yesterday. Yeah.
You know what's not going to help them, though? Any tariffs is the thing. If they have, the small caps are going to get hit particularly hard.
Where were you when you learned about this additional, these additional tariffs? 10% more on China, 25% Mexico, Canada. I thought we liked Canada.
So my husband was on the couch, and I was rolling out my back on the floor, and he said, "Oh, Trump tariffs." He just tweeted something, and I was like, that's what happens. This is my job. We've done this for a long time. All right. Speaking of, Fed minutes showing that officials prefer gradual future rate cuts, saying that the data came in as expected, inflation continuing to move down to that 2% level, and the job employment picture looking okay. It would be appropriate to move gradually towards a neutral stance. Joining us now for more is Bloomberg's Michael McKee, international correspondent, joining us there. Mike, how do we know if it can gradually get sustainably down for 2% when the tariff situation is very much a question mark?
Well, that's an interesting question. I think as far as we can predict is the December meeting, and that's going to depend still on data to come in like the jobs report on December 6th. After that, all forecasts have an expiration date, I think, of January 20th. We don't know what's going to happen, and nobody really knows what's going to happen. Interesting point with what you and Romaine were just talking about. In the Fed minutes, it was noted that some of the Fed bank presidents talking to their contacts out there, CEOs at companies, said companies that were larger and in more information-related spaces were much more optimistic about the future outlook for the economy than smaller companies and people who were in manufacturing. So that's something to keep an eye on as we go through the earnings seasons or the earnings calls.
This gets to an idea, too, and I know everyone's sort of really trying to put a number on what the tariffs could potentially, the impact could be here. Are there any parallels, though, Mike, between what we saw during the first Trump administration, because it's not like we haven't been here before, and maybe what we can extrapolate to what 2025 and beyond will look like?
Well, the hard part is the tariffs we got during the first Trump administration were targeted at specific industries, particularly in the steel and aluminum industry, which was a kind of global tariff, but one industry oriented. And what we saw there was prices went up. We saw imports go down, but American steel prices went higher because they could. And that was part of what the whole point was. And so Americans ended up paying more for steel. And what ended up happening is people who used steel lost jobs. So the effects were basically negative. And that's something you could look forward to going on here if we get these other tariffs. But the problem with these are going to be if they're broad, if they're across the board, then you're going to have major impacts that I don't even know how people are doing forecasts because it is so complicated. Yeah,
exactly. And I think that Best Buy actually put it nicely on their earnings call today, saying that, look, if you wind up getting tariffs, costs are shared. You got the vendors going to share some, we're going to share some, being the company, and the consumer is going to share some. And that was a really clear way of, like, we're all going to pay in some capacity.
Yeah, that's exactly what happens, and dozens of economic studies have shown it is the consumer who ultimately pays when you have tariffs because the prices get passed on. But when you look at what could happen with the cross-border tariffs between the U.S., China, Canada, and Mexico, I mean, the automobile industry, there's something like $38 billion worth of parts that go back and forth, and they go back and forth as many as 7 times before they are put into a car. Now, how many times do they get tariffed? And who pays that tariff? And do they get tariffed at all? These are all things that are impossible to determine. You look at avocados, 90% come from Mexico. 2/3 of our tomatoes come from Mexico. if you put tariffs on that, it's not like we're going to be growing more here.
Yeah.
So it's very hard to figure out what the impacts of this are, other than to say they would be bad.
Absolutely here. And you're also, of course, seeing that already play out in the auto space. Michael McKee down in the D.C. Bureau as we keep the conversation going on, trying to extrapolate the potential impact of those tariffs. Investors selling off the automakers. Stellantis having its worst, down at its lowest level since 2022. Ford down a couple percentage points. But take a look at General Motors, 8.5% near session lows. This is the biggest one-day sell-off for that company since at least 2021. Keith Naughton joining us right now, a Bloomberg reporter out there in our Detroit bureau. And Keith, you heard Mike just kind of talking about this, the dependence that we have on Mexico right now for a huge chunk of our auto manufacturing, assembly, whatever you want to call it here. Should we be this concerned? Are these market moves an appropriate reaction?
Yeah, well, when you look at GM and Stellantis in particular, they're getting 40% of the vehicles they sell in the United States are made in Mexico. So, and importantly for those two companies, they're big money makers. Chevy Silverado pickup trucks and heavy-duty Ram pickup trucks come out of Mexico. Ford has 25% of its U.S. volume coming out of Mexico. And let's not forget Canada. That's also a place where Stellantis builds minivans and Ford builds SUVs. So it's both markets are integral to the U.S. operations of these automakers, and a 25% tariff would drive up sticker prices, drive up costs. It would be really devastating for the industry.
Keith, this is an insanely dumb question, but if also part of the shift is to say to these guys, look, let's build a factory here in the U.S., let's break ground, here's your shovel. How hard is it to actually do that?
Well, if they did build a factory in the U.S., those jobs would not materialize during Donald Trump's term. It takes a long time to build a factory, which doesn't happen very much. We have lots of capacity in North America. We don't need more. So it's not something that would pay off immediately. The immediate payoff will be that car prices will go up even higher. They already average $48,000 a car, and more people are dropping out of the market because they can't afford a new car anymore.
Well, that's what I'm curious about, Keith. I mean, prior to some of the uncertainty that's cropped up as a result of the election, were we actually starting to see vehicle costs normalize to a certain extent? Because I know this was a big issue with EVs and the sort of the slowdown in adoption, the costs, and even with traditional gas-powered vehicles. Anyone who's bought a vehicle in the last couple of years knows that it is astonishing. I bought one this year, and I'm still complaining about it, Keith.
There is a serious affordability crisis in the new car market. The price of new cars now are what we would have considered luxury prices just a few years ago.
Yeah.
The price of new cars have gone up by more than 25% in the last 5 years. And those prices have not come down as, inventory has normalized after the pandemic. Mm-hmm. So there is already an affordability crisis in the car market, and this will make it worse.
So does that mean, Keith, that we could see carve-outs? And if there are carve-outs for cars, could this all be just chatter and nothing real?
Well, I would say this go around, people are clutching the pearls not quite so tightly on this threat. I think people have come to know that Donald Trump opens with shock and awe, and then we start negotiating. So I don't think anybody, the analysts or anyone, are really expecting 25% tariffs to go through unscathed.
Okay, Keith, thanks a lot. Bloomberg's Keith Naughton joining us there. Let's get to the White House now. President Biden is now speaking.
Hamas and Israel. Hours later, at 2 a.m. in the morning, Hezbollah and other terrorist organizations backed by Iran attacked Israel in support of Hamas. Let's be clear. Israel did not launch this war. The Lebanese people did not seek that war either, nor did the United States. Over the past year, including the days immediately following October the 7th, I directed the U.S. military to flow assets and capabilities into the region, including aircraft carriers, fighter squadrons, and sophisticated air defense battery, to defend Israel and deter our common enemy at critical moments. Since the war with Hezbollah began, over 70,000 Israelis have been forced to live as refugees in their own country. helplessly watching their homes, their businesses, their communities as they're bombarded and destroyed. And over 300,000 Lebanese people have also been forced to live as refugees in their own country. And a war imposed on them by Hezbollah. All told, this has been the deadliest conflict between Israel and Hezbollah in decades. How many of Hezbollah's senior leaders are dead, including its longtime leader, Nasrallah? And Israel has destroyed Hezbollah's terrorist infrastructure in southern Lebanon as well, including miles of sophisticated tunnels, which were prepared for an October 7-style terrorist attack in northern Israel. But lasting security for the people of Israel and Lebanon cannot be achieved only on the battlefield. And that's why I directed my team to work with the governments of Israel and Lebanon to forge a ceasefire, to bring the conflict between Israel and Hezbollah to a close. Under the deal reached today, effective at 4 a.m. tomorrow local time, the fighting across the Lebanese-Israeli border will end. Will end. This is designed to be a permanent cessation of hostilities. What is left of Hezbollah and other terrorist organizations will not be allowed, well, I emphasize, will not be allowed to threaten the security of Israel again. Over the next 60 days, the Lebanese army and state security forces will deploy and take control of their own territory once again. Hezbollah terrorist infrastructure in southern Lebanon will not be allowed to be rebuilt. And over the next 60 days, Israel will gradually withdraw its remaining forces. And civilians on both sides will soon be able to safely return to their communities and begin to rebuild their homes, their schools, their farms, their businesses, and their very lives. We're determined this conflict will not be just another cycle of violence. And so the United States, with the full support of France and our other allies, has pledged to work with Israel and Lebanon to ensure that this arrangement is fully implemented, the agreement totally implemented. You know, there will be no U.S. troops deployed in southern Lebanon. This is consistent with my commitment to the American people to not put U.S. troops in combat in this conflict. Instead, we, along with France and others, will provide the necessary assistance to make sure this deal is implemented fully and effectively. Let me be clear. If Hezbollah or anyone else breaks the deal and poses a direct threat to Israel, then Israel retains the right to self-defense consistent with international law, just like any country when facing a terrorist group pledged to that country's destruction. At the same time, this deal supports Lebanon's sovereignty, and so it heralds a new start for Lebanon, a country that I've seen most of over the years, a country with rich history and culture. If fully implemented, this deal can put Lebanon on a path toward a future that's worthy of its significant past. And just as the Lebanese people deserve a future of security and prosperity, so do the people of Gaza. They too deserve an end to the fighting and displacement. The people of Gaza have been through hell. Their world's absolutely shattered. Far too many civilians in Gaza have suffered, far too much. And Hamas has refused for months and months to negotiate a good faith ceasefire and a hostage deal. And so now Hamas has a choice to make. Their only way out is to release the hostages, including American citizens, which they hold. And in the process, bring an end to the fighting, which would make possible a surge of humanitarian relief. Over the coming days, the United States will make another push with Turkey, Egypt, Qatar, Israel, and others to achieve a ceasefire in Gaza. With the hostages released and the end of the war without Hamas in power, that becomes possible. As for the broader Middle East region, today's announcement brings us closer to realizing the affirmative agenda that I've been pushing forward during my entire presidency. A vision for the future of the Middle East where it's at peace and prosperous and integrated across borders. A future where Palestinians have a state of their own, one that fulfills its people's legitimate aspirations, one that cannot threaten Israel or harbor terrorist groups with backing from Iran. A future where Israelis and Palestinians enjoy equal measures of security, prosperity, and yes, dignity. To that end, the United States remains prepared to conclude a set of historic deals with Saudi Arabia, to include a security pact and economic assurances, together with a credible pathway for establishing a Palestinian state and the full normalization of relations between Saudi Arabia and Israel, a desire they both have. I believe this agenda remains possible, and in my remaining time in office, I'll work tirelessly to advance this vision for an integrated, secure, and prosperous region, all of which strengthens America's national security. Getting all this done will require making some hard choices. Israel has been bold on the battlefield. Iran and its proxies have paid a very heavy price. Now Israel must be bold in turning tactical gains against Iran and its proxies into a coherent strategy that secure Israel's long-term safety and advances a broader peace and prosperity in the region. Today's announcement is a critical step in advancing that vision. And so I applaud the crazy decision made by the leaders of Lebanon and Israel to end the violence. It reminds us that peace is possible. Say that again, peace is possible. As long as that is the case, I will not for a single moment stop working to achieve it. God bless you all. I'm sorry to keep you waiting so long. May God protect our troops. Thank you.
The President of the United States there, Joe Biden, walking away towards the White House, letting it be known that a ceasefire agreement has been struck between Israel and Lebanon. Of course, a military conflict that has been waging ever since October 8th. That was the day that Hezbollah started to fire missiles into Israel in solidarity with Hamas, which, of course, had launched that horrific attack on October 7th to claim the lives of at least 12,000 people, almost all civilians. In an effort to tamp down the violence, not only along the Lebanon and Israeli border, the President of the United States saying that he will now focus his attention on trying to create a ceasefire in Gaza. Bloomberg Balance of Power co-host Kailey Leinz is standing by right now. I'm sure you heard what the president had to say. You heard what Benjamin Netanyahu had to say just a couple of hours prior. A temporary ceasefire, but Biden says that this is a path to a permanent cessation of the war.
Yeah, which is a bit stronger language than what we've heard from the Israelis and from Netanyahu, who maintain if Hezbollah is to do anything to violate this, although Biden did suggest the same, Israel can still take action to act in its own defense. But this is obviously a massive moment for President Biden in his final months here in office, announcing that the U.S., which did have a heavy hand in brokering this agreement, along with France and, of course, the Israelis and Hezbollah and Lebanon itself, have reached this agreement for a 60-day cessation of hostilities that the president just informed us will begin at 4 a.m. local time. So really just a matter of hours from now. And over the next 60 days, he said Israeli forces will be withdrawn from these areas and civilians can be able to return safely to their homes. President Biden laying this out as a path to potentially a permanent ceasefire, though, of course, that will take much more work. And 60 days from now, I would point out, we will have a different president of the United States. The inauguration of Donald Trump is just 55 days away. So that has the power to potentially shape the way in which the situation in the Middle East moves forward. But over the course of the next 55 days, while he's still in office, as we just heard the president say, he says he will continue to push toward peace, specifically a ceasefire agreement between Israel and another Iranian proxy, Hamas. And he mentioned specifically getting the hostages home, which do include some Americans that remain there. So this is also about legacy definement for President Biden as he's getting ready to leave the White House.
And I just want to make a quick correction here. I misspoke and said that 12,000 people had been killed in that attack that was launched by Hamas on October 7th. It was 1,200 people, roughly, and counting. Alex?
Yeah, Kailey, I guess the question then becomes, what kind of roadmap might we now know that could lead to a ceasefire between Hamas and Israel in Gaza?
Well, it's important to remember, and I've been reminded of this with a number of Middle East experts I've spoken to today, Alex, is that these two conflicts, while they are kind of emanating from the same thing, which is, of course, tension between Israel and Iran, and these are different proxies that essentially serve on behalf of Iran, they do remain very different in nature. And so it isn't necessarily true that a ceasefire between Israel and Hezbollah will easily lead to one between Israel and Hamas, which, of course, Israel has stated repeatedly its goal is to completely eradicate Hamas in Gaza. And there remain very significant questions, and President Biden just alluded to that, of what the day after in Gaza ultimately looks like. Whether we get an independent Palestinian state, as the president made clear, is his desire, or Israel is only going to agree to something in which they are still able to exercise a certain amount of control to make sure Hamas is not the one in control of Gaza. So the nature of that is obviously very different. And I would point out it was up until recently that Hezbollah maintained only a ceasefire in Gaza would lead to a ceasefire between Israel and Hezbollah. But clearly the Israelis have been incredibly successful in weakening the ability of Hezbollah, taking out the majority of its high-level leadership, successfully depleting their ability to strike Israel militarily, and hence why we've found ourselves now with Hezbollah agreeing to this, too.
Well, that's my question here. I mean, who is doing the agreeing? And maybe you don't have the answer to that question, but, there's always the fear with these types of agreements that, okay, you get the leaders on board, and then you get some faction of Hezbollah or Hamas that decides, they're going to do their own thing, and then we're basically circle back to square one.
Yeah, and that's the very point of this temporary deal being temporary in nature, Romaine. It's only going to be 60 days to start if it indeed can stick for that long. And then the permanency of that remains a massive question, reminding everyone that it was only months into the initial conflict between Israel and Hamas that we did see a temporary ceasefire in place. And then obviously the war has proceeded for months after that once it came to an end. So these things are incredibly tenuous, and it's not just the proxies themselves and those who are mediating between the proxies and Israel, but Iran does play a role here too. These are Iranian proxies we're talking about, and how the feeling is in Tehran about the way in which the proxies are able to kind of execute this war against Israel, which obviously has been ongoing for some time now, dating even before October 7th, is going to play an incredible role here. And this is a situation that the incoming Trump administration will be inheriting.
All right, Kailey, really appreciate it. Thank you so much for that instant analysis. Kailey Leinz, Bloomberg Balance of Power co-host. All right, we're about 9 minutes away from the closing bell right here in the U.S. We're looking at an S&P that is higher on the day, sitting at a record high. I'm going to say it again, 52nd record high for the S&P so far this year. Now, materials, though, the worst performing sector in the S&P, remain, which makes some sense if you're dealing with some tariff threats as well. General Motors, the worst performing stock within the S&P, and tech also going stronger as well. More insulated, if you will, with this particular tariff situation.
Yeah, absolutely here. And a lot that's going to have to be parsed as we get into next year. But for right now, I guess some folks, at least for that top line on the screen, will take it as they get it. Emily Roland joining us right now, co-chief investment strategist at John Hancock Investment Management, counting us down to the closing bell on a day where we are looking at an S&P that looks like it's going to notch a record high, a Dow that's going to notch a record high. And a lot of people asking, when do the record highs stop, Emily? Is the environment just right for this rally to continue?
It is. Momentum is on the side of investors right now. And not only have we seen, risk assets broadly see new all-time highs every day, but there's almost this sort of speculative frenzy that's building across assets, everything from low quality growth at any price type companies to crypto and crypto related assets. There's a sense of investor euphoria, I think, permeating markets right now, based on potential political policies. I don't know if I've ever used the word potential more. We still don't know how some of this stuff is going to play out, but also some, modest upside surprise that we've seen on the economic growth front, a better than expected earnings season. Yeah. A lot of great stuff being priced into markets right now. Yeah,
I am curious. I mean, I always hate to look at gift horse in the mouth, Emily, but is there too much euphoria? And we talked about this last week on the program, about this idea that you don't really see a whole lot of downside hedging. I mean, it's one thing to be bullish. It's another thing to say, I don't need any downside protection whatsoever. And I'm wondering, when do we get to that breaking point where maybe things are just tilted a little bit too much to the positive side?
Yeah, I mean, I think the consensus is very much one-sided on the positive direction. And in order for everything that's priced in to happen, you've got to see continued appreciation across asset prices. You've got to see profits now beating what's going to be double-digit earnings growth that's being priced in by analysts for the next several quarters to come. And you've got to see this continued sense of investor utopia. By the way, all of those things might happen. But the challenge, again, is that the S&P 500 is sitting at 22 times forward earnings. So sometimes when everybody's on one side of the boat, the proverbial boat, we know sometimes it can tip over. So we want to think about, pruning risk into some of these rallies and more speculative pockets, thinking about, mitigating risk with allocations to higher quality, more defensive options in this environment where there is a lot of speculation and a lot of momentum.
You set me up, Emily. Where are those places?
Yeah, so we continue to follow the earnings. Stock prices follow profits over time, and we're seeing of the best earnings growth trends within U.S. large caps. Mega cap tech continues to be an area that we like, but of course we've got a valuation problem there. The S&P 500 growth index is trading now at a 54% premium to its 20-year average. So we're balancing the valuation risk in that area of the market by looking at places like U.S. mid-cap stocks, where we're finding quality at a reasonable price. Mid-caps have a significant sector overweight to the industrial space, which we see benefiting from continued investment in the U.S., onshoring that's happening, fiscal spending that's being funneled into a manufacturing renaissance in the United States. And then finally, we're legging into some more defensive options here. Healthcare is a sector that's trading at a 10% discount to the broad market, offers great return on equity, good balance sheets, high quality. And then looking at utilities as another more defensive area that we can see benefiting as the consumer potentially sees some headwinds into next year.
But, I'm taking a look at the FA function on the Bloomberg terminal when it comes to the mid-cap index. I mean, valuation is slowly creeping higher here. Like, it's no longer as cheap as it was just even a few quarters ago. So, like, how do you measure that?
Yeah, I'm so interested that you pointed that out, because Matt Miskin and I right now, he's my co-chief investment strategist of the firm, we're writing our 2025 outlook. And by the way, I'm sorry, I realize we're a little late this year to this one. It kind of crept up on us with a later Thanksgiving, but one of our kind of headlines might be the valuation gap in mid-caps is closing. So you want to take advantage of it. The good news is when you look at valuations, we want to take a close look at the denominator and the PE ratio, and it suggests that earnings growth trends are improving. Industrials earnings actually tend to do well late in a cycle because a lot of the projects that are being invested in are longer lived. They have more stable cash flows being directed towards them. So we do think mid-caps do have some legs, but we've been talking about them for over a year. And we think now, if you haven't done it, it's the time to lean into that space.
All right, Emily, got to leave it there. Great stuff. Emily Roland, co-chief investment strategist at John Hancock Investment Management, here on a day with 9 of the 11 S&P sectors moving higher, Alex, setting up for what is going to be another record high for the indices. But as Emily was just talking about, no participation today from some of those small and mid-cap indices.
No, not really. You are seeing utilities, though, outperform within the S&P as well. Energy got an upgrade, which helped the rest. But still, you could also make an argument maybe a safety play as well.
Interesting to see the pop in Eli Lilly on this day, up 4.6%. I thought we were over the weight loss drugs.
No, not Medicare and Medicaid pay for it. Bring it home.
I heard the Biden administration wants to propose that in the month that they have left in office. A full breakdown of all the market coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through that closing bell, a global simulcast. It starts right now. Scarlett Fu here in the TV studio. Carol Master showing up for a second day of the week. Tim Stenovic, as always, right by her side. As we welcome our audiences across all of our Bloomberg platforms.
I had nothing better to do, so I thought I'd show up.
Including our partnership with YouTube. Carol Master, guess what?
Guess what? Another record
high on the S&P 500.
Because everything is awesome. No, it's kind of interesting on a day where we're seeing some progress in the Middle East, although many would say not done yet, and certainly in what's going on in Gaza. But it's kind of interesting as we continue to get more information about what a Trump White House looks like and where we are in the world. Another record here.
I'm pretty surprised to see stocks move higher today. Look, the Treasury trade is a little different, and we'll talk about that in just a minute. But after that news last night that Trump said he'd impose 10% tariffs on goods from China, additional 10% tariff on goods from China, 25% on all products from Mexico and Canada. I'm surprised to see the muted market reaction. Yes, some stocks are lower.
Yeah. Well, I mean, if you run the EQS function, you can sort by the U.S. companies that have outsized exposure to China or to Mexico, et cetera. If you look at those names, they're all getting killed today.
Ford, General Motors, a couple of my decliners.
Yeah.
I mean, this always raises the question.
Do you want to go through those now, Tim?
No. Just giving you a little deep tease.
This always raises the question of whether this 25%, 10% number that he floated were just trial balloons, the start of a negotiation, or that he could actually take action, executive action, and hit the ground running on day one.
Also, we've seen the playbook.
Yeah.
This is what we had to manage and deal with back in 2016 also.
And it carried through the Biden administration, right, in terms of some tariffs.
Yeah, absolutely here. Well, we get the closing bells in New York, and it is green across the screen, at least for the most dominant of the indices. The OG up 122 points, or about 0.3% here on the day. The S&P 500 up about 30-plus points, or about 0.6%, 6,021 and change. It takes a while for these numbers to settle, but I don't think anywhere they're settled right now is going to take it from that record high. The NASDAQ composite up 100-plus points, up about 0.6%. But to the downside, it was the Russell 2000 leading the declines with a drop of 0.7%.
All right, back to the big caps we go. The S&P 500, guys, almost an even split, but a little bit more to the upside. 272 names actually gaining ground on this Tuesday. Scarlett, 229 to the downside, 2 unchanged.
All right, and 9 of the 11 industry groups in the S&P 500 finishing in the green. Utilities, consumer discretionary, and communication services leading the way, with utilities up 1.5%. Your weak parts of the market, materials and energy. Energy just barely lower by 1/4%. Materials losing 2/3 of 1%.
All right, guys, to the individual gainers, to that play off of the news that the Biden administration is proposing a rule to require the U.S. government to basically cover those obesity drugs for millions of Americans. It would increase Medicare costs by a lot. We're talking about $25 billion over the 10 years. But for companies like Novo Nordisk, that one was up about 1.5%. Eli Lilly up about 4.5% in today's session. So we definitely saw those stocks gain in the session. Quick over to Wells Fargo. It was up at its highs about 1.5%, finishing the day with a gain of 0.6%. It may be at a new record, and I'm just pulling it up on the Bloomberg. Yep, closing at a record. Reuters reporting the lender is in the last stages of a process to pass regulatory tests to lift that $1.95 trillion asset cap in 2025 after fixing problems from the fake account scandal. This is according to 3 people familiar with the situation. So that could be a blessing, certainly for those who are trying to be bullish on Wells Fargo. And NRG Energy, I had to mention, number one gainer in the S&P 500, up 10% today, jumping to a new record high. Yeah. Jefferies upgrading the company to buy from hold, and also, I think, upping its price target. Let me just pull it up. 113 from 93, stock closing at 101.
That's kind of a redundant name, right?
Which one? I know, NRG, I know.
Yeah,
I'm sure there were consultants who were paid a lot of money to come up with that.
I'm sure they were.
Okay.
Hey, let's go to some of the decliners. I did mention shares of U.S. car makers fell today. I want to highlight what happened with General Motors, down 9%. Worst day going all the way back to March of 2020. That's never a good sign. This is over concerns that President-elect Donald Trump's planned tariffs on goods from China, Mexico, and Canada are going to hit those companies. A couple bits of information here. Stellantis, Volkswagen, Ford, and GM would be highly exposed to an increase in tariffs on Canada and Mexico. This is according to an analysis over at Bernstein from a couple days, actually from this morning. Stellantis and VW import about 40% of the vehicles they sell in the U.S. GM imports roughly 30%, and Ford about 25%. That's according to that note from Bernstein. So that's why you see shares of these companies taking a hit today. Also, shares of Kohl's down 17% today. It's actually at the lowest level, going all the way back to 2020. The company cut its full-year sales outlook. It signals struggles in the retail environment. We've seen pressure on retailers who cater to these middle-income shoppers because consumers are becoming more budget conscious. They're shying away from big-ticket purchases and discretionary spending. Shares of Kohl's fell today by 17%. And finally, Amgen fell by close to 5%, 4.76%, after the experimental obesity shot failed to significantly outperform rivals and show a high rate of gastrointestinal side effects. Amgen shares fell as a result. The shot did help patients lose up to 20% of their body weight. Analysts had expected it to help patients lose around 25%. That would help it compete against shots from Eli Lilly and Novo Nordisk.
There was a takeaway that, like, be best, be first. And Amgen was neither of those things.
Or be to 26%.
Yeah, there you go. All right, taking a look at the bond market here, guys. The belly of the curve still selling off a little bit, but otherwise we're pretty much flat on the day. At a 5-year auction, did pretty well. We get a 7-year tomorrow, about $44 billion. Taking a look at that.
All right, let's get to some earnings here. So a couple of software companies reporting, including Workday and Autodesk. Autodesk shares relatively unchanged here. This after their most recent quarter showed operating income coming in slightly above street estimates. EPS at $2.17. The street was looking for roughly $2.13 a share. The forecast going forward for the fourth quarter, the current quarter, the company sees adjusted EPS of $2.10 to $2.16. That's the range they're giving. The street, on average, was looking for $2.12.
I'm going to jump in here with Workday, another application software company. Third quarter adjusted EPS beating estimates, $1.89 versus $1.75. Revenue of $2.16 billion, also higher than anticipated. It did narrow its outlook when it comes to full year subscription revenue. $7.7 billion is the new outlook, whereas previously it was looking for anywhere from $7.7 billion to $7.73 billion. As for adjusted operating margin, 25.5% is a forecast, whereas previously it saw a range of 25.3%.
All right, guys, let's get to Dell crossing the Bloomberg terminal. And let's get to the red sticky that Bloomberg is highlighting. Third quarter infrastructure solutions group. We're talking about revenue that's coming in pretty much in line with expectations, $11.37 billion. The estimate on the street was $11.34. Third quarter total net revenue. That too is a little light, just barely, $24.37 billion. The estimate was $24.59 billion. And I should point out that Dell, we are definitely seeing some reaction here in the aftermarket. Stock down almost 5%. It has been on a tear. It is up 85% year to date. So again, seeing some disappointment in these numbers.
Okay, let's take a look at shares of CrowdStrike, down now by about 4.2%. That company coming out with numbers. The company sees fiscal year revenue coming in at $3.92 to $3.93 billion. That is above estimates. That came in at $3.89 to $3.9 billion. Third quarter revenue did beat estimates. $1.01 billion estimates were for $983.1 million. Adjusted earnings per share for the third quarter also did beat estimates. Still, shares down about 2.5%.
Department store chain Nordstrom out with its results. It looks like it beat on both the top and bottom line, though the market reaction to the downside. Third quarter adjusted EPS, 33 cents a share. The street, they wanted 22 cents a share, so a 10-cent beat. Net sales also coming in slightly above estimates at $3.35 billion. The street was looking for $3.28. The company says that it's going to stand by the full year EPS forecast that it had previously given. That's a range of $1.40 to $1.70. Not seeing a full year revenue estimate here, but overall, it looks like they beat on most of the metrics here. But again, looks like investors wanted something a little more.
Let's also get to Urban Outfitters, the specialty retailer coming up higher in after-hours trading right now. Third quarter comparable retail segment sales up 1.5%. Analysts were looking for a gain of 1.25%. And when it comes to third quarter adjusted EPS, $1.10 beating the consensus estimate of 86 cents.
I thought Urban Air was cool when I was like 15. Anyway, going back to Dell for a second, because that stock's still getting hit really hard, I wanted to highlight one thing. So within the infrastructure solutions group, we mentioned that revenue came in bang on line with estimates, but the servers and networking revenue, which is where the AI server part is housed, came in a little bit light. It's still up 58%, but it's about $7.4 billion. Now, this is an area where they were trying to take market share from Supermicro, so I'm wondering what the read-through is on that. I didn't see any forecast for that particular part of the company in their earnings release yet.
And a little bit of commentary and context, Alex, from the company's COO, Jeff Clark over at Dell, saying interest in our portfolio is at an all-time high, driving record AI server orders demand of $3.6 billion in the third quarter and a pipeline that grew more than 50%. So interesting for a little bit of color there, but nonetheless, again, investors not impressed. Stock down almost 6% in the aftermarket.
Yeah, more from the vice chair and COO over at Dell, Jeff Clark, saying that our AI momentum accelerated in the second quarter, increased the number of enterprise customers buying AI solutions each quarter, optimized server demand up 23% sequentially, and $5.8 billion per year to date.
Hey, what do you guys think Alex was like at 15?
She was cool. She was cool.
I think she was amazing.
Oh my God.
I think she was tough. Were you tough on your mom?
I mean, she would say yes. I would say obviously no, except for all those curfews that I broke.
I think she was super smart. She was a gymnast. Like, what else?
This is an offline combo, guys.
Wow, I know. Wow.
This is a way offline
Keep going.
combo.
Keep going, Carol.
This is called Alex Steele. This is your life. This is what we're doing. All right, guys, that's a wrap. That's a wrap. A lot of earnings, a lot of stocks moving the aftermarket. We're going to say goodbye for now, but catch us tomorrow, same place, same time for the closing bell.
All right, our coverage continues here on Bloomberg Television. Romaine Bostick sticking around with Scarlet Fu. Alex Steele off to go visit her 15-year-old self. And Steve Sosnick going to be joining us in just a second, chief strategist at Interactive Brokers. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlet Fu.
And I'm Romaine Bostick. A record high for the Dow, a record high for the S&P 500. And underneath the hood, you actually saw some modicum of strength out there. Pharmaceutical stocks having yet another up day here. In fact, that indice right now has been up for 6 straight days. That's kind of a reversal from the 5-day sell-off that it had prior to that because of concerns here about some of the Trump president-elect picks for his new administration, particularly in the healthcare space. The dollar continues to get a bit higher, in Bitcoin, whatever momentum that we saw last week, at least for right now, appears to have been lost.
Yeah, so put away the $100,000 party hats for now. Let's look at some of the big movers in after-hours trading. We had Nordstrom report results. Earnings per share and sales beat analyst estimates. It's keeping its full-year earnings per share outlook right now. That's good enough for a 1% gain in after-hours trade. CrowdStrike, the cybersecurity company, falling about 3.5% after its fourth quarter EPS outlook missed analyst estimates, looking for anywhere from 84 to 86 cents. Analysts wanted to see 87 cents on average. And Dell down about 5% right now, lower than expected sales due to a decline in its PC business. Its infrastructure unit, which includes servers, saw a 34% increase in sales driven by demand for AI optimized servers. But the PC part of the business stalling out.
All right, and we are still waiting, of course, results out of HP Inc. in just a bit. We'll bring you those as soon as they cross the wire. Before a broader scorecard on what's been going on with this earnings season, let's bring in Steve Sosnick. He's chief strategist over at Interactive Brokers, and he joins us here in Studio 2. Steve, great to see you.
Great to see you, too.
This earnings season is pretty much all but over. I mean, we've gotten all the names that we care about the most here. I mean, when I look at it in aggregate and I look at the numbers, it seems great. Was it great?
It was good.
Yeah,
it was good. I mean, we got sort of the couple of percent increase in earnings, year over year that we wanted. Most of the companies, as usual, beat by the requisite penny. It's no longer necessary to, it's no longer sufficient to beat your earnings. It's necessary, but it's really about the guidance. It's really, you know what? Everybody got hip to that. If everybody beats, then the average is not the average. But so it's good enough. I think really the key here was we didn't hear anything scary in terms of guidance. Yeah. So markets are still anticipating double-digit earnings growth for next year because the companies haven't told them not to.
I am curious, though, particularly with some of the guidance. Obviously, some of the earnings and some of these conference calls, of course, happened prior to the election. So there are going to be major policy changes that are going to have an impact on corporations to a large degree, maybe positive, maybe negative here. Is it too early to try to model that in now, or do investors just kind of sit and wait for the administration to actually formally take power?
I think investors should try to model it in as best as they can, but to a certain extent, we're sort of abdicating that responsibility, right? I mean, today we had that tariff, last night, I guess we had that tariff story. Mm-hmm. GM reacted because it's fairly obvious how that could affect them. But from the broader market point of view, it's like, hey, let's shrug it off. 6 of the Mag 7 stocks are up, and so we have an up day. So I do worry that, we've sort of abdicated the responsibility that it's because it's difficult to model, because you have an incoming administration, an incoming president who, can be all over the place sometimes. I think it's unfair to just sort of say, we'll worry about it when the time comes. Mm-hmm. And that is why I think, as the pendulum has shifted from fear to greed, mm-hmm. It might be time to get, be a little more fearful, be a little more cognizant of hedging and things of that nature.
So if investors are not modeling it out because they're like, we'll believe it when we see it, how are companies going about planning for this? And at what point did they start saying something more concrete?
I think they're already starting. I mean, think, for example, about the comments made by Walmart last week and earlier this week. They are very cognizant of what tariffs could do to their business because, if you start slapping a tariff on anything they import from China, they have no choice but to pass it along. And I think they fired their own set of warning shots saying, this is not going to be good for ordinary consumers. I think quietly behind the scenes, they're all doing it and planning as best as they can. I know that if I were running a company now, I'd be consulting with anybody I could to give me some clarity into what might come down the pipe. But I think the market as a whole, the investors are willing to think about it fairly charitably. Okay, tariffs, well, they're just a bargaining position right now. We won't worry too much about it. Well, the ones where it's clear, we'll worry about it. The ones where it's unclear, we'll just kind of carry on.
Okay, so does Walmart doing that, kind of spelling it out, give permission to other companies to do that as well? Or are they going to wait until they actually have something much more concrete, something more substantive to say?
I think it behooves everybody to keep their mouths shut as best as they can unless it's fairly clear. And I think that's why we're not hearing a lot from the companies, because first of all, no management wants to be wrong. No one wants to go out there and say, we're preparing for X and then Y happens. On the other hand, also, nobody really wants to draw the fire from the administration, as it were, by saying things that may or may not be true or
play out.
Yeah.
All right, so that Steve Sosnick giving us a sense of how companies and CEOs are a little bit reluctant to be straightforward about some of the outlooks there when it comes to tariffs. Steve Sosnick is chief strategist at Interactive Brokers.
All right, HP earnings crossing the wire. This is HPQ, of course, HP Inc. Basically, in that adjusted fourth quarter number, their fiscal fourth quarter numbers, it looks like they missed on a couple of key metrics here, and that appears to be why you're seeing the market reaction there. Right now, EPS did come in line with estimates at about 93 cents a share, though net revenue looks like it might have come in a touch light here. There's a big focus on free cash flow for this company. It beat in the most recent quarter, but the biggest concern here is the guidance going forward here. The company actually seeing its 2025 free cash flow at about $3.2 to $3.6 billion. It looks like the high end of that range might encapsulate to a certain degree what the street was looking for, but the low end of that range certainly below the average of estimates.
All right, let's also go to Guess, the specialty apparel retailer reporting revenue, missing analyst estimates, net revenue of $738.5 million. Analysts were looking for $749 million. EPS also missing the mark by about a nickel, 34 cents for the period, an operating margin of 5.8%. That stock tumbling about 9% in after-hours trade. All right, coming up, we're going to stick with earnings. We're going to break down the other companies that have reported, including Workday, Urban Outfitters, and Nordstrom. That's coming up next. This is The Close on Bloomberg. All right, a wave of earnings in the last couple minutes. Let's get you a roundup of some of the notable movers and bring in Bloomberg's Bailey Lipschultz, Emily Grafeo, and Isabel Lee. Bailey, let's start with you. You've got Workday.
Got Workday, Scarlett, under a bit of selling pressure post-market, down 6%. This comes after beating expectations across the board in 3Q. But when you look towards that guidance for the final quarter of the year and the remainder of the year, that's where they fall incrementally short. Fourth quarter forecast for subscription revenue, $2.03 billion. The street was looking for $2.04 billion. And their 2025 year forecast subscription revenue coming in at $7.7 billion. They had seen a range between 7.7 and 7.73. Estimate was for 7.72. So we've seen throughout this earnings season companies that can't beat and raise guidance falling under a bit of selling pressure. Again, down 7%. We've seen over the last 8 earnings reports double-digit moves in more than 4 of them. So it is a stock that can be volatile. It is, all things considered, a smaller company. But again, third quarter beating guidance for 4Q and the rest of the year, though, falling short of what Wall Street was looking for. That's why Workday is lower. But Emily, you've got some green on the screen.
Yeah, I do have some green on the screen. Urban Outfitters up 5% right now after posting record net sales for the third quarter of $1.36 billion. That beat estimates. The company also beat on adjusted EPS, coming in at $1.10 per share versus the 86 cents a share forecasted. Urban Outfitters has their own business segment, but they're also the parent company of brands Brands, Anthropologie, and Free People. Both of those segments beat on sales as well. The shares are only up 12% year to date, but overall, this was a pretty good earnings report for a retailer, considering what we saw with Kohl's earlier today and also Abercrombie, which also posted record sales, but investors didn't seem satisfied with that number. Isabel, you have another retailer.
I have another retailer, but it's back to the red for me. We have Nordstrom down by 0.5%. The company raised the lower end of its annual guidance after its off-rack and flagship chains reported growth that was better than expected. So this could encourage the company's board to push the founding family for a better offer to take Nordstrom private. Shares are still lower by 0.5%. As a background, the Nordstrom family in September made a $3.8 billion offer with a major shareholder to buy shares that they still don't own. So back to earnings, Nordstrom is also forecasting that annual sales will be flat this year versus last year. That's narrower than previous guidance. The company also said that the top end of the outlook is slightly below expectations, which is why you're probably seeing some red on the screen, because we see the top and the bottom line beating estimates actually. But the more important thing is the upbeat annual outlook stands in contrast with some of the retailers that have reported in the previous seasons. And also we have the company saying that they feel well positioned for this holiday. So that's an important thing because we have Christmas ahead of us. Back to you, Romaine and Scarlett.
All right, our thanks there to Isabel Lee, Emily Grafale, and Bailey Lipschultz. Of course, not much going on with Nordstrom there, but the 5 biggest decliners right now in the after-hours trade, all in the tech space, with Workday now down 8%.
Isabel talked about being well positioned for the holidays. First, it's T-minus 2 days until Thanksgiving. And of course, this is a time to gather and enjoy a delicious meal with loved ones, although many consumers continue to feel the impact of rising prices. Our next guest says Thanksgiving can actually be one of the most reasonably priced holiday dinners to put on the table. Joining us now to discuss is Stu Leonard Jr. He is president and CEO of Stu Leonard's, and he is in the company's Norwalk store. Stu, it is great to speak with you. I want to start with that idea that Thanksgiving can be one of the most reasonably priced holiday dinners. Why is that? When the turkey is expensive, there's a lot of side dishes that go along with it. What are you comparing it to?
Well, you know what, Scarlett? First of all, it's nice to be here. And by the way, hey, Romaine, look, you're the first one we've ever had. I got your name on whatever. Okay. So you're noted in the store already here. You know,
I'm big in the produce aisle.
But you know what? If you look at your Thanksgiving table, you're talking about things like stuffing, turkeys. You can get them 99 cents up to $2.99 a pound. That's $3. You go over to the deli department, you're going to pay $12 for sliced up and gold turkey or something like that. So chicken breasts are $3.99, $4.99 a pound. A turkey's not that expensive at the holidays. And then you have a lot of vegetables on the side. You have a pie. You get all done, and it really doesn't cost you. It might cost you $12, $15 a head for Thanksgiving. That's a pretty good price. Think of what you can get out in the market today. If you go out to McDonald's or something, how much you'll be spending today.
That's true. A McDonald's meal regularly set you back $15 to $20. So, Stu, you sell more than 20,000 turkeys every Thanksgiving. Yeah. And if you look at the price of turkey this year versus last year, what surprised me is that it's either the same or even actually down.
Right. Well, we have a couple turkeys we sell. One of them, we sell it. It was $2.49 last year. We lowered the price actually to $1.99. That's a bright spot for customers. We also have another turkey for $2.99, which is, it's fresh. I would recommend everybody listening get a fresh turkey. The other thing is free range, so it gets to eat from the grass outside. And the third thing that's really nice about that turkey is vegetarian fed. So that's sort of your gold standard. The turkeys we sell also, one of them gets sent down to the White House every year, special order.
Oh.
So we're seeing people spending this year. I think the confidence is really high. Shrimp platters are going, fruit platters. Nobody wants to cook anything. We have a dinner for 8 in a box. You get everything from the rolls all the way to the sides and everything. That's on fire.
Yeah.
I think most food retailers, I don't know about the other retailers you mentioned with the market, but we feel really good about the economy and what's happening right now.
Right. But I'm sure you also know, Stu, there are a certain segment of the consumer base that are, paying a little bit closer attention to their pocketbooks. And so once you get beyond the Thanksgiving holiday, for those folks who are coming into the store and they do need to save money or at least be mindful of it, do you have any advice for them?
Well, one of the things, Romaine, we're seeing people go for our apps more, which are the specials every week, whether we have blueberries or strawberries or filet mignons on there. So they're going for the deals. A lot of people are freezing things now. They learned that during the pandemic. And so you're seeing customers save money that way. Another way is to go private label. We're seeing an increase in private label products right now. You can save about 20% doing that. Mm-hmm. And then the third thing I tell everybody, don't get tempted by the demos that are in the store because But
that's half the store, Stu. I mean, what am I supposed to do? Half the reason we go to Stu Leonard's is because we can just walk around and sample everything.
Yeah, I know. Yeah. Well, we like Costco does that a lot. They put a lot of demos out, and it works. People like to taste things before they buy.
Yeah, people do, and that'll not stop me or you, I'm sure, Romaine, from trying out the samples that are available. Talk a little bit about shrinkflation, because as much as the price tag itself may not be moving as much, people have certainly noticed over the last couple of years the thing that you're buying is getting smaller and smaller, and it's not immediately noticeable. It's when you put it on your plate and you realize, wait a minute, I'm still hungry.
Well, Scarlett, a good example is Tropicana. We had a container of their orange juice in the store, and they just reduced the size of it. And our sales have dropped like 20% when that happened. Customers are smart. They're all of us, all listening and everything. I mean, you understand what's going on out in the market today, and customers want value. And if they see the value diminishing, they're just going to do something really simple. They're going to vote with their feet. So we got to keep our prices sharp at Stu Leonard's.
Yeah.
And we got to give customers good value.
But how do you do that from the supplier side, Stu? I mean, how much pull do you have in being able to negotiate with suppliers to make sure that the price you're paying, is something that, again, ends up being commensurate with whatever discounts and bargains you want to offer your consumers?
Well, what you have to do is negotiate with them a little bit. What I've been doing all through the pandemic, and they all the farmers are calling me. It costs me more to put fuel in my John Deere tractor. I got to pay more for labor. I mean, they all, give you the story right there. And what I've done is ask them, look, I'll split it with you. So I'll go 50-50 the price increase that you want. And it's not much. It might be 10 or 20 cents a pound, but still the farmers' costs have been going up. So you got to negotiate a little bit. Like I could get a good deal on one of our turkeys this year. I called up our other turkey farmer. He said, I can't give you a deal this year. I got to leave the price the same as last year. Right. You know what? It's a relationship we've had for 10, 20, 30 years with these people. And they're friends of mine. Yeah. The Christmas tree grower up in Canada. You got to try to get the best price you can, but you also want to make sure you get the quality and you get the supply. They don't short you.
Hey, Stu, we really appreciate you doing this. And before we let you go, I see you got a lot of fans behind you. I mean, you're obviously the biggest thing in Norwalk, Connecticut today. Yeah. But I have to ask you, where is Diva Cheese? Is she in Norwalk right now, or is she still
Diva
sort of making
Cheese,
the rounds?
come on over, girl. Hey, Diva Cheese, we got her. Diva Cheese, did you have Diva Cheese traveling? Okay, look at the best part of my day. I get to work with my daughters. Okay, so Chase, what did you do with Diva Cheese at the store?
She went on tour. She was a singing animatronic on tour.
And where is Diva Cheese? It's one of her animations.
She's coming back soon to Danbury.
Yeah.
All right. Well, we're going to keep an eye out for her. I think we had a chance to see her when she made the rounds in Yonkers a while ago.
Happy Thanksgiving from our family to yours.
Thank you very much, Stu. Really appreciate it. Stu Leonard Jr.
I'm gonna eat some of this on the holiday.
Be delicate with it. Stu Leonard Jr., of course, the president and CEO of the grocery chain. Stu Leonard's there ahead of the Thanksgiving holiday on Thursday here in the U.S. We want to pivot from that and go back to something a little bit more serious when it comes to the economy and, more importantly, the contours of the new Trump administration. There's been a lot of polarizing discourse around some of President-elect Trump's cabinet picks, and the market is still mulling, of course, Scott Bessent's nomination to head the Treasury Department. Former New York Fed President Bill Dudley has a message for Bessent. Good luck to you. He says you're going to face two big challenges if confirmed: ensuring that the bond market functions properly and coming up with a fiscal policy that sends our debt service costs soaring. We're happy to have Bloomberg opinion columnist Bill Dudley join us right now to talk a little bit more about that. And Bill, I don't know if that was a thank you note or something else, but I mean, let's start with the second part of that and on the fiscal side, because this is obviously the one that I think everyone is so laser focused on. What sort of, I guess, power do you think he's going to have to really address that issue independent of his boss, who's going to be sitting, just across the road there?
He's not going to have the power to do, whatever he wants on tax and spending policy. Obviously, that's up to the president and Congress. But I think he can explain very clearly the consequences of not having a good set of policies in terms of what that means for the budget deficit path, the consequences for interest rates, and if interest rates go up, the consequences of interest rates for broader markets, including the stock market. So I think he can, essentially be the voice of reason to make sure that the policy mix is actually intelligent and that the fiscal path of the U.S. is put on a more sustainable one. Mm-hmm. Right now, we have budget deficits 6% of GDP or more, as far as the eye can see. And President-elect Trump has said that he wants to cut taxes. He wants to extend the 2017 taxes cuts and cut corporate taxes even more. And, how are we going to pay for that? So I think there needs to be someone in Treasury who's viewed as credible, but not just credible with markets, but also credible with President-elect Trump.
I am curious. I mean, two components of the job of Treasury Secretary. On one hand, they do effectively act as an advisor to the president, but they're also basically a salesman to a certain extent. They have to go out to the public, to investors, and sort of convince them that these policies coming out of the White House are productive and, more importantly, going to benefit them. Do you think what you know about Scott Bessent, do you think that salesman aspect of it, that he has the chops for it?
Well, we'll see. I think what he does have is credibility with market participants. And you saw it over the last 24 hours. The market reaction to his being named has been very favorable. Stock prices up, bond yields down. So people are happy that they have someone at the U.S. Treasury that's knowledgeable about financial markets. Now he's just got to take that knowledge of financial markets and make sure it actually affects policy, and that we have prudent policies in terms of tax policy and prudent policies on where the deficit's going over the longer term.
So that's where I want to go, because you say the markets were cheered by the nomination of Scott Bessent. But what exactly about Bessent has the bond market so relieved? When the reporting shows that commitment to tariffs, which we know are, or which we believe will be inflationary, was a key deciding factor for the president-elect in his pick.
I'm not sure how strongly the incoming Treasury Secretary is in favor of tariffs. I think he understands tariffs might be a good negotiating tool, but actually raising tariffs is going to drive up inflation. It's going to drive down economic growth, and it's going to hurt productivity. So it's sort of a pretty bad mix. Now, if you're using it to just get concessions from other countries and you don't actually have to enact the tariffs, then I think the consequences are much more favorable. Mm-hmm. But, we just saw President-elect Trump talking about, day one, hugely increased tariffs on Canada, Mexico, and China. Now, if that happens on day one, there are going to be pretty significant negative consequences for the U.S. economy.
Yeah, and we're seeing that already in shares of GM and Ford and Stellantis, for instance. If he had the room to kind of set his own agenda, what should the incoming Treasury Secretary focus on first? What's the first thing he needs to tackle, do you think?
Well, I think there's two things. I mean, number one, he needs to keep focusing on making sure that the Treasury market works properly. One of the problems that we've had over recent years is the amount of debt that we're distributing has gone up far faster than our capacity to actually distribute it. The market is relying on algorithmic trading firms that basically are there during good times, but during bad times, they leave the market. And then the focus turns to primary dealers, the big securities firms. And they don't have the balance sheet capacity to come in during times of stress because that balance sheet capacity has already been allocated elsewhere. So Treasury market function is important. And then the second is making sure that fiscal policy is on a more sustainable path. Right now, we have a lot of competing interests here. On one hand, the President-elect Trump talked about lots of different kinds of tax cuts during the presidential election. On the other hand, we have the Department of Government Efficiency. We'll see how much that and how much tariffs will raise. So there's basically a big tug of war between let's cut taxes and then where are we going to get the revenue from?
Yeah, there's going to be definitely a tug of war between that and the markets, and certainly even potentially internally. I am curious about some of Scott Bessent's past proposals or past comments, particularly when it comes to this idea of a shadow Fed chair, which I'm sure you're familiar with. I don't think you would be for it, but I am curious as to where that idea even comes from. What is the rationale for that?
Well, the rationale for that is to sort of undercut the power of Chair Powell before his term expires in May of 2026. So the idea would be you'd appoint someone else to be governor. You'd make it very clear that that governor was going to be the next chairman. And in some sense, Powell at that point would be a lame duck. I think it's a dumb idea because I think policy right now isn't really about the future. It's really about today. In other words, how the economic data is coming in. I don't think the Fed has basically got a long-term view of where policy is necessarily going to go. They're going to adjust policy based on what the data tells us about growth and inflation. So, if the Fed policy is data-driven, what some shadow governor says about what he's going to do a year or two down the road isn't really very, very relevant. The second thing is I think it's a bad idea because it just will put markets on edge. To the extent that the Trump administration wants to constrain Fed's independence, it's going to be counterproductive because if they do it, then every time the Fed does something, people are going to be wondering, is the Fed doing that because they think it's the right thing to do to keep the economy on a good trajectory, to keep inflation in check, or is the Fed pulling its punches, doing it because of pressure from the administration?
But doesn't the market always do that? I mean, whether it's Powell now under a Biden administration or Yellen or Bernanke or Greenspan?
No, I don't agree with that. I think the Democrats for many, many years, going all the way back to Bob Rubin in the early 1990s, have been very, very cautious about ever criticizing the Fed. And they know that because it's counterproductive. When you criticize the Fed, you call into question all their decisions. You put market participants on edge. That forces market participants to build in higher risk premiums. So interest rates are higher as a result. Stock prices are lower as a result. It just doesn't get you anything. I mean, all it gets you is someone to blame when things go badly. That's all it gets you.
All right, Bill Dudley, really appreciate your being candid with us. Bill Dudley is a Bloomberg opinion columnist, and of course, he is the former New York Fed president. We wanted to give you a recap of some of the other movers in the after-hours trade. HP Inc., of course, is the company name, down 7.25%, giving a fairly lackluster profit outlook. That slow PC market recovery weighing on the company. Dell Technologies, a similar story there. That stock is losing ground by about 6.5% in after-hours trading. The Infrastructure Solutions Group revenue is one area of focus for investors. And Urban Outfitters, slightly higher in after-hours trading right now, up 1.4%. Anthropologie reported some sales gains there, and that is cheering investors. This is Bloomberg.
Ready, set, shop. The National Retail Federation predicting a record 183.4 million people are planning to shop in-store and online from Thanksgiving Day through Cyber Monday this year. Joining us to discuss what she's seen when it comes to the strength of the consumer is Michelle Meyer, chief economist and head of the Mastercard Economics Institute. And I just want to correct that update. I'm actually done all my shopping for Christmas.
You always do this every year.
I'm an early bird.
I know.
So I'm the outlier.
You
and
pull
I know
forward
this.
your spending.
Yeah, I pull forward my spending, though. But to that point, though, Michelle, I saw a lot of discounts.
Yep.
I mean, even like back in October, I mean, it was hard to pass up.
Yeah.
I mean, and these were like legitimate discounts, 30, 40. We're just going to talk about my shopping habits for this whole segment, so prepare yourself. But is this, in all seriousness, though, did we see or are we seeing any sort of pull forward of some of that spending, or is this all going to be compressed to the post-Thanksgiving day season?
Yeah, so I think the retailers got you.
Yeah.
That's exactly what they wanted to do, which was to put deals to show value and to entice consumers earlier in the season. It is certainly not just about one day. It's not just a Black Friday that matters. It's the period of time heading into Black Friday where retailers prepare for the holiday season and consumers gear up and get ready and try to find that value. And I think a lot of that has to do with the fact that we have so much more e-commerce spending and so many more players in the space that provide those choices for consumers to engage.
I am curious about that. And we've talked about this a lot over the years about shopping trends, and it kind of almost gets to the point where it kind of makes Black Friday as a day kind of irrelevant,
Obsolete,
right?
yeah.
But it gets to this idea too is, if you are a consumer who's maybe budget conscious, do you start early and shop, or do you wait maybe and hope that as you get closer to the Christmas holiday that you'll see bigger discounts?
I think you do it all. I don't think there's one answer because I think it depends on when you feel like you're getting the best value. And value can be in a lot of different ways. It can be value in that you're shopping for that one thing you know you really want to get for a friend or a family, and once you find it, you're going to go ahead and secure it. Or it can be you simply just want the best price, which means that you may wait and see what kind of promotions you get in Black Friday, and then you may wait and see what you get in Cyber Monday, and then you wait and see until one day before Christmas in terms of getting those promotions. It also is a factor of...
Can I tell you a little trick I use too? I always make sure that they have very generous return policies.
Yes. Well, yes.
So that if I do see another item or a bigger discount, I can just send it back.
So it is interesting you say that. One thing that we observe when we look at our own insights is that there's an incredible seasonality to returns. Returns are extraordinarily low in November and December, and they do spike in January. So I do think there's something to your strategy, which is you know that you have that flexibility and consumers want that flexibility.
Romaine is so proud of his shopping
You're doing
capabilities.
well. You're doing really well.
No, this is something you talk about every year.
I do. I bore her to tears every year.
No, it's the contrast that you paint between me and you. We know middle income and lower income consumers are really feeling a lot more insecure this time around. And the earnings report from companies like Walmart to Target make that clear that consumers are seeking value. My question to you is, what is value? As long as they're employed, what does that value look like? Is it discounts, or is it just more for the same price?
Yeah, well, I think it's that consumers want to feel empowered, and they actually have been empowered in the last year or so because inflation has been moderating quite substantially, and there's a lot of choice out there for consumers in terms of how they spend, where they spend, what they spend on, and that's hard for retailers to navigate because they have to figure out that mindset of the consumer and how the behavior is going to continue to shift. But when you think about the fundamentals driving consumers right now, a lot of it goes to the labor market, and we are still seeing job creation, we are still seeing wage growth in excess of underlying price inflation, and that allows the consumer to have some flexibility on aggregate.
So Romaine talks about how he buys his Christmas presents early. We know that inventories have been a big theme this earnings season overall. Because of the port strike, a lot of companies, stocked up and everything. Romaine stocks up because he sees deals out there.
Right.
But what does the research show on whether consumers are likely to stock up if they think there's going to be, tariffs coming on imported goods? Like, is that something that factors into their decision making?
Yeah, I do think it matters. So it certainly matters for retailers. When you look at import data, you're certainly seeing a rise in imports as retailers are trying to get ahead of what could be tariffs and higher prices for raw and intermediate goods. For consumers, I think that's probably the case for some of the larger appliances or some of the larger items where it's a meaningful price point. And if they're sharing the tax from tariffs, it could really make a difference. But I'm not sure that's the main driver today for consumers. I think right now it's about making sure you're checking off your list for the holiday season and doing so at the best value.
One thing that I always like about you guys over at the Mastercard Institute is you guys have some great sort of data, demographic data. And I am curious, who's spending more? I mean, not to start a whole generational fight here, but there's always the idea that older people tend to spend more, obviously, because they have the means, but the younger people, of course, have a lot more discretion into what they can spend. So where are we going to see more of the spending this year, more of the dollars flowing?
Well, unfortunately, we don't have the ability to cut it quite by demographics, but we do have the ability to look at a number of different cohorts in the economy to see how spending trends fare and how that fares on a regional basis and across different categories. So there's lots of interesting, unique perspectives that we can offer. But I don't think it's just one story. You know, I think it's in general this time of year, consumers are out, they're eager. But they're very conscious of how they're using their dollars.
But just to be clear, I mean, you guys are forecasting an increase.
We are. We're looking for 3.2% for the holiday season.
And that's in dollar value relative to last year.
Correct.
Okay.
3.2% total during the holiday season, which is pretty similar to what we had last year, but the composition is different in terms of the categories. The other thing that I think is probably unique somewhat to this year relative to the past few years is we're operating in an environment of disinflation or even deflation for a lot of categories, the big ticket items. So what you could end up seeing is actually more real volume, real consumer spending, which is also showing up in the GDP numbers, right? When you look at the Q3 GDP number, it was real consumer spending that was quite robust, particularly for durable goods, because prices have been coming down.
All right, Michelle Meyer, always a pleasure.
Thank you.
Michelle Meyer is Chief Economist and Head of Mastercard Economics Institute. And of course, we're staying on the consumer here because in the Conference Board's latest confidence report, buying conditions for those big ticket items have dropped as many households remain financially stretched because of elevated borrowing costs and the rise of the cost of living over the past few years. Joining us now to discuss is someone who can speak to this from a new perspective. He is Silvio Tavares, CEO of Vantagescore. It's a national credit scoring company, kind of the rival, the main competitor to FICO. The big takeaway in what you're seeing right now, Silvio, is that consumers entered this holiday shopping season with high levels of debt. But is that enough for them to put off spending, or are we going to get to that 3.2% increase Michelle was just talking about?
Yeah, we have a more modest view on the upcoming consumer spending season. And part of that is we're seeing high-end consumers struggling more with their ability to take on debt. We saw that in the most recent Vantagescore credit gauge, which we published just this morning. And what it shows is a surprising jump in delinquencies for those more affluent, higher income consumers. That's a headwind heading into the consumer holiday spending season.
Yeah, that is a surprise. I had not realized that. At what point does that start showing up in people's credit scores in a meaningful way and make them much more aware of what their limitations might be?
So late payments typically appear as soon as a month after that late payment is made. But don't get me wrong here. If we look at the overall VantageScore average credit score, a low score is 300, a perfect score is 850. The average consumer through the end of October was at 702. So that's a very healthy credit score that reflects some of the other data points that you've had on your show today. So the overall consumer is doing quite healthy, but of course there are a few areas where there is weakness. One area is we're seeing an increase in this sort of inflation contagion hitting the more affluent consumer, and that's a surprise and of concern as we head into the holiday spending season.
I am curious about that because, I mean, we've kind of focused a lot this year on the lower end consumer and the potential struggles that they might be having. If the higher end consumer is either tapped out in credit or at least at a point where they feel like they don't want to spend anymore, when do we start to see the effect of that in the economy?
Well, Romain, you're exactly right. You know, if you look at the total average credit card balance through the end of September, it was about $6,300. It stayed the same through the end of October. So what that tells you is consumers aren't increasing their leverage very much. I think the reality is we're going to have to watch that. The value-conscious consumer might still see deals. I'm not projecting a Grinchy Christmas, but I think, in fact, there will be some increase in spending, just not as high as we've seen in prior periods.
Is the idea, though, too, I mean, we talk about the amount of spending that people might do this holiday season. I am curious just from the perspective of the lenders, if you will, for lack of a better phrase here. Are they being more strict with regards to credit? You know, you have to have this credit score before we extend you, this money to buy this car or to get a new credit card. Have you seen an increase in that?
Yes, and there's a difference in what banks say they're going to do and what consumers say they're going to do and what they actually do. And what we saw in the most recent period is that banks actually pulled back on lending across every major credit category. auto loans, credit cards, mortgages, there was a lowering of growth in terms of increase. That tells you that banks are somewhat cautious entering this period of the year. And I think it also makes it less likely that the Fed is going to actually decrease rates at its next meeting.
I got to ask you also about something else that's kind of looming, which is the looming student loan risk if President-elect Trump overturns Joe Biden, his loan forgiveness program. How much is that showing up in the data or on the minds of consumers as we move towards that?
It's not showing up yet. We're going to see those results in January as the consumer loans start being reported once again. And what you could expect to see is a lowering in the average VantageScore through January. That hasn't happened yet, but when it does, consumers are going to be surprised by that submarine debt all of a sudden appearing on their credit reports. And we anticipate that consumers are going to further moderate their borrowing at that point. And banks, quite frankly, are going to be more concerned about lending to a consumer with a lower credit score. We anticipate that to hit in January.
And how big a hit might that be?
Well, it depends on the individual, but for an individual consumer that hasn't repaid their loans, they're going to expect a hit of as high as 80 points on their credit score. That's quite meaningful. That can slip a consumer from a really good credit risk to what is perceived as a low credit risk. So what we say to consumers is stay up on those loans. Now's a good time to start budgeting repaying. The silver lining is if you do that, you will actually expect to see an increase in your credit score because you weren't getting the credit for those payments you made on time in the past.
That gets to a question, though, about your just business overall, and I'm talking about you and your peers here. And how transparent is that process? I mean, in the old days, I think we all had a very negative view of credit scores because it was kind of like this black box. And I know this day and age there are a lot more tools out there. We would kind of track our debt and our spending levels and have a very concrete idea of how much that's going to affect my credit score.
Yeah, Romain, I'm glad you mentioned that because the key to consumer credit health is actually knowing your credit score. VantageScore was the pioneer in really developing the ability for a consumer to look at their score themselves. Over 220 million Americans check their credit score every day using a VantageScore. If you're a Chase,
every day?
Yes. If you're
not every day. Now I feel like maybe I should now.
Right. Well, if you're a customer of the nation's largest bank, Chase, and you check your credit score, that's a VantageScore. And so we were a pioneer in that because nobody likes a gotcha moment, right? Yeah. You want to know what your score is before you apply for that loan. And increasingly, we're seeing consumers really take control of their credit health.
When do people do that? So, I mean, a good example is, I bought a car earlier this year. So that was, I definitely checked my credit score because I wanted to just kind of see and know what I was walking into. But other than like big ticket items, do people check their credit scores when they're just going to do their holiday shopping or do something maybe a little bit more minor than just buying a house or car or taking out student loans?
You'd be really surprised. The reality is consumers do check their credit score for that because today a credit score is not just used for credit. It's used for a variety of things. I was speaking to a CEO recently. He was applying for a lease and they checked his credit score. And we're seeing the volume really increase significantly. So, for example, last year, VantageScore grew volumes by 43% to 27 billion scores. So we're seeing huge growth in that usage.
They check your credit score too even when you're paying cash for a car.
I know, and when you open a new credit card, they check your credit score. So you can't, open too many credit cards because that might be a problem.
Sylvia, you got to tell them to stop doing that.
Yeah, happy Thanksgiving to you both.
Likewise, Silvio Tavares is CEO of VantageScore.
All right, we're going to set you up here for what could potentially move the market over the next 24 hours. Stick with us. A lot more coming up right here on The Close, right here on Bloomberg.